Hello, this is Brian Rezny, president of Rezny Wealth Management, bringing you the Rezny Wealth Report. As always, we will be taking your calls and questions, so make sure you do send those to Brian Rezny at ReznyWealth.com. Getting your questions answered is the first step in order to improve your financial retirement, portfolio, and really your financial security. So again, any of your questions, send those to Brian Rezny at ReznyWealth.com. And don't forget to visit our website, ReznyWealth.com. Currently, we have the 3 biggest risks you must avoid now. We see some catastrophic problems not only in parts of our economy, but in the world economy. We're looking at potentially a major pullback in certain asset categories, 20-30% drops. We're also looking at the potential for a rolling recession or recessions in certain countries that need to be avoided. If you care about your wealth, if you want to protect your retirement, go to ReznyWealth.com, download for free the 3 biggest risks you must avoid now report. It's free, instant download, and it's only available at ReznyWealth.com. You know, I want to talk a little bit about, generally speaking, what's going on in the economy. As we're clearly going into the second half of the year and we're firmly into the third quarter, approaching that fourth quarter, a lot of investors are wondering, you know, what happened the first half of the year? Why didn't you make money with your portfolio? I'm getting a lot of calls and questions on my TV and radio show from people just like you, where they didn't make really any money or maybe even lost some money the first half of 2023, even though the overall markets have done quite well. And let me explain why. Investors are finding ultimately that set it and forget it portfolio management is just not working for their wealth. But what works better? In our opinion, what works better is making adjustments to that portfolio timely with investment asset categories or investments that are showing promise of earnings growth, revenue growth, in order to get a higher share price potential. I think a lot of investors, unfortunately, this kind of is across the board with a lot of the banks and Wall Street style firms, they do kind of a stock asset allocation, and you're always kind of invested in too many different categories. Some may be good, but other of those categories that are over-diversified drag your portfolio down. A lot of the big Wall Street firms and banks, for most of the first half of this year, 2023, we're calling for a major recession at the beginning of the year. We're calling for a 20 or 30% drop in asset prices. It didn't happen. In fact, the opposite happened. The first half of this year was quite good for the S&P 500, up over 15%. But what's interesting is in the last month or two, a lot of these Wall Street firms and banks now are saying, we called it wrong. And now they're getting you invested as the market, parts of it, is starting to roll over and is grossly overvalued. So again, set it and forget it does not work. The asset class pie that is often pushed on many investors, in our opinion, is not effective. What should an investor do if they find their advisor isn't really an advisor at all and they're just selling you the firm's expensive investment products? How do you protect your wealth? That's another big one that's come up on my TV and radio shows in the last few months. We're finding more investors are starting to get educated, and we hope we're giving you a good education through our TV and radio shows on what to look for in a real advisor or a real money manager. As I've talked repeatedly, the only kind of firm you should ever entrust your money to is a fee-only fiduciary money management firm. Wall Street firms, banks, and insurance companies are not fee-only. Most of them don't manage money, and they're really creating products that they're selling you, the consumer. And a lot of those products are more that set it and forget it mentality. They have high expenses, and it ultimately is creating more risk in your portfolio and your financial security during retirement. As an investor, I urge you to go to ReznyWealth.com. If you want to learn how to protect your wealth, download our 3 biggest risks report. Learn and educate yourself. The other report that would be excellent for those of you who are realizing maybe your advisor isn't an advisor at all, and you want to make sure you find a proper firm that's going to guide your portfolio in the way that you feel it should be guided, download Real Advisor, Fake Advisor Report, another great education. I think too many investors today, unfortunately, take it for granted that big firm is actually legally working for you and actually watching and babysitting your money, but unfortunately, they're not. So protect your money. Any of those reports are free at ReznyWealth.com. You'll learn a lot, you'll protect your wealth, and ultimately, you'll be able to make even better decisions around your wealth, which will help secure your retirement and your family legacy. Justin in Florida, your thoughts on REITs for income? Justin, excellent question. REITs stand for Real Estate Investment Trust. So there's two kinds of REITs. There's non-traded REITs, meaning they're non-traded and they're not liquid. And then there's traded REITs. These would be kind of like a stock, but they own a basket of real estate. And you can buy and sell those at any point. First off, never ever buy a non-traded REIT. Non-traded REITs are not liquid. You can't get out if things go south. And unfortunately, they have these huge upfront cost structures, often approaching 18 to 20% of your initial investment, which is really a bad ripoff for you. And they're not liquid. So when things go south, you're stuck in an investment going down and jeopardizing your retirement and your portfolio. Traded REITs, on the other hand, would be a better opportunity if real estate was currently a place you should be. But I will say this, given the state of the economy, not only in the U.S. but around the world, given the state of an over-excess of real estate, commercial real estate, whether that's office buildings, some apartment complexes in certain parts of the country, maybe retail fronts, some of these areas are grossly overbuilt in some parts of the U.S. and the world. And they're falling fast and they're losing occupancy rate. So we do not like real estate currently. That may change in 6 months or 6 years. We're doing our research. But I would currently not own any real estate investment trust traded because I think there's better places for your money. Philip in Naples, Florida. What is your top picks for dividend stocks as a strategy? Phil, another excellent question. Number one, we do not just look at dividend stocks. We want to look at all stocks. And some dividend stocks make sense. Other stocks that maybe don't have much of a dividend or no dividend that are more growth oriented may make more sense in a portfolio. So think about this. About 10 to 15% of stocks really pay a meaningful dividend. So that means if you only look at dividend paying stocks, you're excluding 85% of stocks that pay either almost no dividend or no dividend at all. And those might be the best total return investments in your portfolio. So do not look at just dividends, look at all stocks. And again, this is where a lot of research comes into play. You want companies that are growing sales and are growing revenue. Both of these are key for the opportunity for that share price to go up. You probably remember a company called Sears. It was the richest company in the world 30, 40 years ago. It's no longer in business, but they were growing their sales and revenue, and that's one of the reasons that the stock did well until they had competition, and then it didn't. So again, research, research, research. I'm going to take a quick break. Make sure you visit ReznyWealth.com. Download any of our groundbreaking reports, the 3 biggest risks you must avoid now if you're a retiree, a pre-retiree. If you are at all second-guessing the advice you're getting, if you're concerned about the pending recession and the collapse of the U.S. economy or the collapse of the stock market around the world, if you're concerned maybe set it and forget it isn't working for you, the 3 biggest risks you must avoid now is a must-read for any retiree who ultimately wants to get that education to make smart decisions. Go to ReznyWealth.com. I'll be right back after this. Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report radio and TV show. I've just released a groundbreaking report, the 3 biggest risks you must avoid now. I've covered the major risks that create financial ruins for many retirees. If you're at all questioning the advice you're receiving, this is a must-read report. Go to ReznyWealth.com for your free copy. Educate yourself, protect your retirement, and portfolio. I really hope you're enjoying today's program. And again, send your questions to Brian Rezny at ReznyWealth.com. One of the things that I want to discuss is really the next time bomb to go off in the investment market. This is probably the biggest risk I see, not only in the U.S., but other parts of the world. And it's commercial real estate in trouble with some of the localized banks that are lending to that commercial real estate. Remember, every cycle changes. Real estate changes over time. What people want, where the demand is. Think about retail. You used to go to malls all the time, these big retail malls, that a lot of them are shutting down and getting bulldozed down for something else. Everything has its time and place. Commercial real estate, in our opinion, is one of the riskiest propositions, not only in the U.S. equity market, but also the regional banks that are lending to these institutions that are buying commercial real estate. And why is that? Well, if you own a commercial strip mall, as an example, and your occupancy rate is now running 60%, you're not bringing in enough rent to pay the mortgage. The bank's not getting paid. Those small regional banks, which are the typical lenders to this location type real estate, a lot of these could be in potentially big trouble and really have some major problems, not only this year, but over the next 2 to 3 years. So again, ticking time bomb, yes. Look at your portfolio and really avoid commercial real estate and traded REITs, in our opinion, at this point. Bill in Naples, Florida. Microsoft, what do you think of their AI opportunity? I think their AI opportunity is exceptional. But remember, AI, artificial intelligence, is something that pretty much all these technology companies are getting into. And it's a good buzzword. I think it's opportunity for another growth cycle in technology, but Microsoft's not going to be the only recipient of that opportunity. There's going to be literally thousands and thousands of companies, not only here but around the world. I think Microsoft will benefit from it. The biggest problem with Microsoft, it's ginormous. And it's going to be very hard for Microsoft to push the needle, meaning get the stock price to perform the way it's performed the last decade, because when you take a big ship and you try to turn it, it can't turn very fast anymore. A smaller company, smaller boat, is much more nimble and can turn much quicker. So kind of think about that. While we like Microsoft and while we own positions in it, I would say you don't want to overload the boat in a company like Microsoft. Look for some other greener pastures. Lou in Fort Myers, Florida. Higher yields and inflation. What are your thoughts? Well, number one, yields clearly are up. The Fed raised rates a lot last year and pretty much the first half of this year. Ultimately, those higher yields are bringing down inflation. So inflation is abating in a big way. Look at some of the recent news coming out of course, China and Europe. You know, if I look at Europe alone, we're looking at points now that it's showing that even Germany could be going back into a recession. So inflation is abating. And one of the reasons it's abating is because of the higher interest rates. It's slowing the growth of the economies down around the world. And we're really no different. And again, that's why I brought up the point. Set it and forget it. Portfolio management doesn't work in this environment. There's times you want to reduce risk. There's times you want to add more bonds or different duration bonds. And there's times you want to own less bonds and more cash. So again, these are things within a portfolio management structure, not a set it and forget it structure, that is vitally important today more than ever. And I think investors who are making those timely changes to their portfolio, or the firm you entrust your money to are making those timely changes, the better that I think you ultimately can do with your retirement portfolio, and the more financial security and knowledge you will gain by making those adjustments. Jerome in Fort Myers, Florida. Europe seems to be struggling. China is in bad shape. What will that cause a recession? You know, Jerome, ultimately, again, I talked about this on the last question. China is really in a deflationary mode at this point. They overbuilt their real estate over the last, let's say, 20 years substantially. They got all these empty buildings that they just built and plowed money into their economies. So now what's going to happen is they created this massive amount of debt, a lot of debt. And we don't know exactly how much debt because China, of course, isn't telling you all this information. But they've massively overbuilt their real estate. The values of this stuff is greatly coming down. In fact, one of their biggest property developers just a couple weeks ago is declaring bankruptcy. So at the end of the day, China is going to be a big problem for China and other parts of the world. I don't think it's going to affect us a lot. But other countries that are dependent on China that are fairly close by are going to have a problem with their economy. One of the things I talked about a lot, not only this year but the last couple years, is investing in the U.S. primarily because we're the strongest, in our opinion, investment opportunity than anywhere else in the world. If you look at how China's market has performed the last 5 years, it's horrific. Our market has done quite well. It's not a guarantee to the future. And not that we're not looking at China. But I will say this, we do not look at deploying any capital in China or foreign investments outside the U.S. anytime soon. We may change our thesis in 6 months or 6 years as valuations even get cheaper, maybe their economies rebound some. But right now, in our opinion, you need to avoid Europe and you need to avoid a lot of the emerging market economies, especially China. I'm going to take a quick break. Go to ReznyWealth.com. Download any of our groundbreaking reports. The number one downloaded report right now is our 3 biggest risks you must avoid now. I think a lot of retirees and pre-retires are looking at the last couple years of their portfolio. They're hearing a lot about the imminent recession coming. You're hearing about a 30% drop in the equity markets. Is it here or is it somewhere else? Can your portfolio withstand a set it and forget it strategy? Or is there a difference? Educate yourself. Go to ReznyWealth.com, click on that special reports tab, download the 3 biggest risks you must avoid now. It is a must read if you are trying to protect your retirement and your family legacy. I'll be right back after this. Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report radio and TV show. I've just released a groundbreaking report. The 3 biggest risks you must avoid now. I've covered the major risks that create financial ruins for many retirees. If you're at all questioning the advice you're receiving, this is a must-read report. Go to ReznyWealth.com for your free copy. Educate yourself, protect your retirement and portfolio. I hope you're enjoying today's program. And as always, go to ReznyWealth.com and make sure you do send us your questions to Brian Rezny at ReznyWealth.com. We love getting your questions. We love answering your questions. And so you can make really a better decision around your portfolio and your retirement. One of the topics I want to cover today is what really hurts retirees and your financial security. You know, I've been managing money well over 30 years. And I'm often asked, you know, Brian, if there was one obstacle that causes a retiree really to basically lose that financial security, maybe have to go back to work, it's really poor investment decisions. And let's talk about that. Many investors focus on the short-term price movement of an investment rather than the long-term value and growth of that investment over time. So think about this. A lot of investors, and actually the vast majority of investors, greatly underperform the stock market and the bond market, looking at the Delbar study that's been going on for 3 decades, over 30 years. And why does the average investor underperform the stock market and the bond market? Because they're looking at that short term. They maybe didn't do the research they should have done, and they're really moving money around based upon emotions or gut reactions, or maybe some headline you read that gets you kind of hyped up, again, to make that emotional decision. That's a poor choice. Many retirees chase hot trends or hot stocks. They follow the crowd, or they speculate. They buy things like Bitcoin, only to find out when they bought Bitcoin at $64,000 a share a few years ago, it's now trading at $26,000, half the value. Chasing trends, chasing what's hot, just because a company made a lot of money last year or the stock price went up a lot last year, doesn't mean it's going to repeat itself. In fact, if you look at a lot of studies, companies that had great outperformance one year are actually often the best companies to sell the next year and maybe rebuy them back at a cheaper price in 12 months. Because it's called the greater fool theory. People will jump onto investments just because they're going up without any research, until the last fool buys and then the price drops substantially. You yourself may have been part of that, where you bought some stocks back in the tech boom and bust, or you bought real estate in 2006 and 7 because it kept going up and you felt you couldn't lose money, but you did. Many investors fail to appreciate the power of compounding, instead look for quick profits or high returns in risky investments. Again, managing money over 30 years has taught me one valuable lesson. Steady Eddie wins the race. You're better off to take a little less risk than speculate with your money. If you're going to speculate, take $20 to Vegas and call it a day. But with your hard-earned money, retirement, and your financial security, Steady Eddie wins the race. You're better to have a more properly diversified portfolio, not shoot for the skies, and not create massive losses that create emotional disturbance and often cause you to make the bad choices. Some investors are actually afraid of losing their money and avoid investing altogether. Or they invest only in super conservative investments like a CD. Again, look at the last 10 years. The average CD rate was 1.5%. Inflation's run probably well over 3%. Throw in taxes, you're losing a lot of money. So you don't need to be ultra conservative, and you don't have to be ultra aggressive. You need to be probably somewhere in the middle. Also, often retirees don't know how to get started. Maybe they saw a commercial, maybe they read something on the internet, and it sounds interesting, but it seems overwhelming or confusing. Remember, any investment that's ultimately confusing, overly complicated, are usually things you want to stay away from. At our firm, Rezny Wealth Management, the primary tools we utilize in a portfolio are stocks, bonds, and ETF or exchange-traded funds. Why? They're very inexpensive cost structure. They can be well diversified. They're easy to understand and research. Complex investments, things like non-traded REITs, annuities, structured products, options, should be avoided by 99.99% of you because they're not good for your money. They're really good for the firm that is selling you and manufacturing those products. Go to ReznyWealth.com, and I know we're getting a lot of questions that are coming in now, but make sure you click on that special reports tab. And as always, if you're concerned about the advice you're getting and it just doesn't seem right, or you're looking for a real money management firm that does not believe in set it and forget it, it actually takes well care of their clients, call our firm during the week for a consultation. We do manage larger portfolios of $1 million and greater. So if you're looking for money management, you're not happy with the way your money is currently being managed, and you'd like to talk to us about managing your wealth, give us a call, schedule a consultation. We could sit down, take a look at what's going on in your current portfolio, and then explain how real money management works and how ultimately you can benefit not only your retirement security, but your family legacy. Sam in Cape Coral, Florida. Do you think semis are a good opportunity like Broadcom, symbol AVGO? We like the semiconductor industry, Sam, and ultimately it's fairly valued, if not overvalued, on certain stocks within the semi region. So what I would say is this: we like it, we own positions, but I would be very cautious at this point of overloading the boat on semiconductors. I wouldn't be surprised if we get a 10 to 20% pullback in semiconductors given valuation, but if you said to me, hey, if we get a pullback of 5 to 10, would you add to positions? I would, because I'm looking at semis really outperforming the next 3 to 5 years. So these are positions we own potentially for a long period of time. We do daily research, and we may change our thesis if something changes with that research. But right now, we like the opportunity, but we think they're fairly valued, and I wouldn't overload the boat again in the semiconductor area. Al from Naples. U.S. Treasuries as yield surge, would you buy? Al, another great question. So think about this. We had interest that was running over 9% last year. We're now running at an annual rate of about 3%, and it appears that inflation is still abating. I see the Fed reducing rates more than they're going to raise rates. If they reduce rates, owning intermediate term treasuries, or long dated treasuries might be a great opportunity. So I don't see rates going up more. If anything, I see these rates stopping, and I see the Fed within the next 3 to 6 months reducing rates. So remember, when rates go up, bond values go down. When rates go down, bond values go up. So now is the time you would want to start adding positions to intermediate to long-term treasuries, because it's not for the income. It's for the capital appreciation you will receive, which could have a great opportunity the next 12 to 24 months. As our economy slows and other parts of the world slow, their Feds and their monetary policy will probably dictate lower rates. So there's some great opportunity, in our opinion, on the bond side and specifically treasuries. Dean in Cape Coral, Florida. Bitcoin sell-off intensifies. Does that create a buying opportunity? Dean, we would not touch any cryptocurrency investments. We believe that cryptocurrency, in our opinion, is a scam. It's speculation. It is basically aggressive, playing Vegas, black and white on the wheel. Do not do it. Think about this. What is Bitcoin? It's nothing. You're buying absolutely nothing. Bitcoin doesn't create anything. It doesn't create profits. It virtually is worthless. But again, I go back to one of my original questions early on, and I talked about the greater fool theory. Bitcoin has gone up in other cryptocurrencies because people saw that it went up. So without knowing what they're buying, they buy Bitcoin. More people that buy Bitcoin, it pushes the price up until the last fool stops buying a speculation investment, and then it collapses and drops to the ground. Are we going to have a digital currency in the U.S.? Yes. Is it going to be by the government? Yes. Are we going to have digital currencies around the world? Certainly will. They're all working on them. So the paper money one day will be gone. And you already have digital currency, by the way, you're utilizing for years. It's called the credit card. It's called your app on your smartphone. These are the things that happen ultimately for you, the investor. Folks, I'm just about out of time. As always, I want to thank you for all your questions. Make sure you go to ReznyWealth.com. If you're concerned about the way your money's being managed or lack of management, if you're tired of that set it and forget it mentality from your current big firm, if you want a firm that has honesty, integrity, compassion, and competence, that's the difference we provide. I think ultimately, if you want to secure your future and your family legacy, call our office during the week and schedule a consultation. We manage larger portfolios of $1 million and greater, or you can visit ReznyWealth.com, click on that consultation tab, and also make sure you do click on that special reports tab and download any of our groundbreaking reports. They're free, educational, and make sure you have yourself a safe and profitable day.